Hey there, future traders. Welcome back to the channel. I'm your host, Finance Inspector, and today we're diving deep into one of the most misunderstood, yet potentially lucrative strategies in finance, arbitrage trading. But first, let me explain what arbitrage actually means in the simplest way possible. Imagine you're at a farmer's market and you notice that one vendor is selling apples for $1 each, while another vendor just 50 feet away is selling the exact same apples for $1.50 each. If you could buy apples from the first vendor and immediately sell them to customers near the second vendor for $1.30, you'd make 30 cents profit per apple. That's arbitrage. Buying something at a low price in one place and selling it at a higher price in another place. Arbitrage trading is doing exactly this, but with financial assets like stocks, currencies, or cryptocurrencies instead of apples. Traders look for the same asset trading at different prices on different exchanges or markets. Then buy low and sell high simultaneously to make a profit from the price difference. So the big question is, can regular people actually make money from arbitrage trading? Well, today I'm going to break down everything you need to know about arbitrage trading strategies, from the basics to advanced techniques that are actually working in 2025. We'll explore real examples, discuss the risks that nobody talks about, and I'll share some eye-opening insights about this strategy. If you're tired of losing money on speculative trades and want to understand a method that can generate more consistent profits, this video is for you. Make sure to hit that subscribe button and ring the notification bell because we're about to uncover some serious trading secrets. Now, let's address the elephant in the room. When most people hear arbitrage, they think it's either too good to be true or only for Wall Street professionals with millions of dollars and high-speed computers. This misconception is costing regular traders massive opportunities. The biggest myth, that arbitrage is risk-free money. Many traders jump into arbitrage opportunities thinking they've found the Holy Grail, only to get burned because they didn't understand the hidden risks. Here's a perfect example of what can go wrong. Let's say someone spots what looks like a perfect cryptocurrency arbitrage opportunity between two exchanges. Bitcoin is trading at $43,200 on exchange A and $43,650 on exchange B. Easy $450 profit per coin, right? Wrong. By the time the transfer completes, not only might the price gap close, but there are network fees, exchange fees, and spreads that can eat up any potential profit. This is the reality of modern arbitrage. The opportunities exist. Crypto arbitrage continues to bring profits due to the bullish trend in the crypto market, and new cryptocurrencies and exchanges are appearing daily, but the execution is where most people fail. Another common misconception is that you need sophisticated algorithms to compete. While institutional players do have advantages, regular traders can still find profitable arbitrage trading opportunities if they know where to look and how to execute properly. The challenge isn't finding price discrepancies. They're everywhere. The challenge is understanding which ones are actually profitable after accounting for all costs, risks, and execution time. That's what separates successful arbitrageurs from those who just lose money on transaction fees. Let me break down the main types of arbitrage strategies that are actually working in 2025, starting with the fundamentals. Pure arbitrage is the classic version where you simultaneously purchase and sell the same asset in different markets to profit from a price difference. Think of buying Apple stock on one exchange for $150 and immediately selling it on another for $150.50. The key word here is simultaneously. Timing is everything. Triangular arbitrage is particularly popular in Forex markets. This strategy involves looking at three different currency pairs and using offsetting trades to profit from price discrepancies. For example, you might convert USD to EUR, EUR to GBP, and GBP back to USD, profiting from inconsistencies in exchange rates. Merger arbitrage is where things get interesting for stock traders. In 2025, merger arbitrage opportunities are emerging with significant potential deals, though they require careful analysis of risks and rewards. When Company A announces it will acquire Company B at $50 per share, but B is trading at $48, that $2 gap represents potential profit, assuming the deal goes through. Cryptocurrency arbitrage has exploded in popularity. Price discrepancies between crypto exchanges occur due to various factors, though risks include transaction delays, high fees, sudden market volatility, and regulatory uncertainties. I've personally profited from Bitcoin price differences between Binance and Coinbase, but you need to factor in transfer times and network congestion. Statistical arbitrage uses quantitative models to identify temporarily mispriced securities. This is more complex but can be incredibly profitable. I use this strategy with pairs trading, finding two historically correlated stocks that have temporarily diverged in price. Now let's talk about what influences success or failure in arbitrage. Execution speed is crucial. In traditional markets, high-frequency trading firms can execute trades in microseconds. As a regular trader, you need to focus on opportunities where speed isn't the only advantage, like merger arbitrage or longer-term statistical plays. Transaction costs are the silent killers of arbitrage profits. Every trade involves spreads, commissions, and in crypto, network fees. Smart traders calculate the all-in cost before even considering a trade. Capital requirements vary dramatically. Some Forex arbitrage requires significant capital to make meaningful profits, while certain crypto opportunities can be profitable with smaller amounts. Market volatility can either help or hurt. Forex arbitrage is still profitable in 2025 if done correctly, capitalizing on price differences across brokers or platforms, but increased volatility can close gaps faster than expected. Technology and tools matter more than ever. While you don't need million-dollar systems, having reliable data feeds, fast execution platforms, and proper risk management tools is essential. The key insight is that successful arbitrage isn't about finding the biggest price gaps. It's about finding the most reliably profitable ones after accounting for all costs and risks. Let me share a story that illustrates both the incredible potential and dangerous pitfalls of this strategy. This is based on a real situation that happened in March 2023, and it shows why understanding arbitrage properly is so important. A trader had identified what appeared to be a perfect statistical arbitrage opportunity between two tech stocks that were historically correlated. Stock A and stock B typically moved together, but A had dropped 8% while B was unchanged. Based on mathematical models, this looked like a sure thing. Buy A, short B, wait for convergence. The trader put on a $50,000 position, expecting to make $3,000, $5,000 over a few weeks. For the first week, everything went according to plan. The gap was narrowing and the position was up about $1,800. Then the unthinkable happened. Company A announced they were being investigated by regulators for accounting irregularities. The stock plummeted another 15% in after-hours trading. Meanwhile, stock B actually rose 3% as investors fled to its relative safety. In one day, the risk-free arbitrage trade turned into a $12,000 loss. But here's the crucial lesson. This taught us that true arbitrage isn't just about mathematical relationships. It's about understanding the fundamental drivers behind price discrepancies. The profitable arbitrage traders, the ones who consistently make money, don't just look for price gaps. They understand why those gaps exist and whether they're temporary inefficiencies or signals of underlying problems. After learning from this experience, successful traders develop what can be called the three-pillar approach to arbitrage. Pillar 1, mathematical edge. The numbers must work after all costs. Pillar 2, fundamental logic. There must be a logical reason why prices will converge. Pillar 3, risk management. Always have an exit strategy for when things go wrong. This approach helps traders avoid countless bad trades and identify truly profitable opportunities. For instance, last month, a trader spotted a cryptocurrency arbitrage between a smaller exchange and a major one. The price gap was only 0.8%, but they understood it existed because the smaller exchange had temporary liquidity issues. They made a clean 0.6% profit after fees because they understood the fundamental reason for the discrepancy. The biggest revelation? The best arbitrage opportunities often aren't the obvious ones. They're the subtle inefficiencies that require deeper understanding of market mechanics to recognize and execute profitably. So what's the bottom line on arbitrage trading in 2025? First, arbitrage opportunities absolutely still exist. Whether it's cryptocurrency price differences, Forex discrepancies, merger situations, or statistical relationships, the markets continue to offer inefficiencies that sharp traders can exploit. Second, success requires much more than just spotting price gaps. You need to understand execution costs, timing requirements, risk factors, and the fundamental reasons behind price discrepancies. Third, technology helps, but it's not everything. Retail traders can compete by focusing on opportunities where speed isn't the only advantage and by developing deeper market understanding. Fourth, risk management in arbitrage isn't optional, it's essential. Even risk-free strategies can go wrong when market conditions change rapidly. Finally, the most profitable arbitrage strategies in 2025 combine mathematical analysis with fundamental understanding and proper risk management. It's not about finding the biggest opportunities, it's about finding the most reliably profitable ones. Remember, arbitrage isn't a get-rich-quick scheme. It's a methodical approach to exploiting market inefficiencies that requires patience, discipline, and continuous learning. But for those who master it, it can provide consistent profits with controlled risk. The key is starting small, learning the mechanics, and gradually building your expertise and capital base. I want to hear from you. Have you tried arbitrage trading? What strategies have worked for you and what challenges have you faced? Drop your experiences in the comments below. I read every single one and often feature the best questions in future videos. If this deep dive into arbitrage trading was valuable, smash that like button and subscribe for more advanced trading strategies. Hit the notification bell so you never miss our latest market insights. In the next few weeks, we will dive deep into arbitrage trading, such as cryptocurrency, arbitrage, crypto arbitrage strategy, Binance arbitrage, and much more. Until next time, keep trading smart. And remember, in arbitrage, it's not about being the fastest, it's about being the smartest.